deferred and contingent consideration in consolidation. In some situations, right, the parent company may decide to pay a agreed amount of cash on a future date. For example, let's say the parent acquires the subsidiary in the year 2000 for $1 million. And then in 4 years' time, the parent company agrees to pay another 600,000. So this is what you call as a deferred consideration. Now, when you look at the initial recognition of a deferred consideration, we will be valuing the deferred consideration at the present value of the payment. So we'll be using our discounting factors and the discounting formula to calculate the present value. And then at the present value, we will be recognizing the deferred consideration. Since this is an amount that is to be paid in a 4-year period, the deferred consideration is considered as a liability. Okay? And then you have another one called contingent consideration. Contingent consideration is when the parent company agrees to pay a certain amount of money, provided that certain conditions are met, right? Provided that certain conditions are met, the parent company would agree to pay as amount of money or maybe a share exchange, right? Now the contingent liability, right, the contingent consideration, right, that we would be recognizing at the fair value, right, because the contingent consideration will change based on the conditions, right, based on the at level at which the subsidiary has fulfilled the conditions, the contingent liability or the contingent consideration would be deferred, right? So we will always recognize the contingent consideration at the fair value, and the fluctuations in the fair value of the contingent consideration, we will be accounting it as a change in an accounting estimate as per the guidelines given to us by IAS 8. Okay, right. So when it comes to your examination, right, to calculate the deferred consideration, right, there are two options. One, they would ask you to use the discounting fraction, and the second one is they would give you the discount factor. Now for an example, let's say a company has to pay $600,000, right, and this 600,000 has to be paid in let's say 3 years. So it's 1 plus R, so our cost of capital, let's say that's 10%. So N is the number of years, so that's going to be 3, right? So the present value of the payment is going to be 600,000 into 1 over 1 plus R to the power of N, which is 3. So it's going to be 450,789. So 450,789. So at the initial recognition, what would happen is my deferred liability will get credited by 450,789, and the investment in the subsidiary will get debited by 450,789. The next one is where the examiner will give you the discounting factor and they will ask you to calculate it, right? So let's say 600,000 is the value of the payment, and they have said that at the cost of capital of 10%, in 3 years time the discounting factor is going to be 0.75. So 600,000 into 0.75, so 600,000 into 0.75, you'll be looking at 450,000, right? So you'll be recognizing your deferred liability, right? Your deferred payments at 450,000. So those are the two methods, right? Now this is the initial recognition. After this, you will be having your subsequent accounting entries, right? Now when you look at the subsequent accounting entries, we will be unwinding the discount, right, of the outstanding liability, right? So let me show you how it works. So previously we recognized that the deferred liability was 450,789. So you take your deferred liability, which is going to be 450,789. On that, you will be charging interest at the cost of capital. So the cost of capital was 10. So we'll be charging interest at 10%. So 450,789 into 10%. The interest we are looking at is 45,079. So 45,079 is going to be the interest. So this 45,079, you'll be adding it to your deferred liability. So your deferred liability will get credited by 45,079, and this is going to be treated as a finance cost. So your finance cost in your statement of profit or loss is going to get debited by 45,079. Okay, so since it is a adjustment coming to the statement of profit or loss, this adjustment will have an impact on working number 5, which is on the group retained earnings. So in adjustment number 5 or group retained earnings, we will have to remove the finance cost from our group retained earnings. So we'll have to remove 45,079, right? So those are the subsequent accounting adjustments that you will see for a deferred consideration, right? Now when you look at a contingent consideration, right, this is much more simpler. Now let's say the contingent consideration is going to be 500,000, right? So in year 2000, which is the year of acquisition, it's going to be 500,000. So the initial recognition here, what we'll be doing is we'll be taking the contingent liability, you'll be measuring it at 500,000, right? But then later on, let's say it goes to 2010, right? Sorry, 2001. This goes to 2001. The value of this is going to be 520,000. So here you can see that the fair value of the contingent liability has increased by 20,000. So that increase of 20,000 will be taken to the contingent liability. So your contingent liability will get credited, and your finance cost or your statement of profit or loss, right? Sorry, in your statement of profit or loss, you'll be debiting this loss of 20,000, right? So those are the adjustments that you see. Since this adjustment is going to have an impact on the finance cost, this will have an impact on the group retained earnings, right? So in our group retained earnings, the change in fair value of contingent liability be taken as an expense, right? So you will remove it from your group retained earnings. Okay, right. So when you look at the investment in the subsidiary under this situation, right, the investment in the subsidiary is going to have the initial payment plus the contingent liability plus the deferred liability. Okay, right. So let's look at illustration number 1. Judy acquired 24 million $1 shares, is 80% of the ordinary shares of Becky, by offering a share-for-share exchange of 2 shares for every 3 shares acquired in Becky, and a cash payment of $1 per share payable 3 years later. Judy's shares have a nominal value of $1 per share and a current market value of $2. The cost of capital is 10%, and the value of $1 receivable in 3 years' time can be taken as $0.75, right? Okay. So you are required to calculate the cost of the investment and show the journals to be recorded in Jack's financial statement and show how the discount would be unwounded, right? So here, when you look at the cost of the investment, first you have the share exchange. The share exchange. Now the terms of the share exchange is we are going to give 2 shares of the parent for every 3 shares acquired in the subsidiary. So we have acquired 24 million shares. So that divided by 3, 24 million divided by 3 into 2, you'll be getting the amount of shares that you have issued, right? So 24 million divided by 3 into 2, so you have issued 16 million shares from the parent, right? and the market value of the shares at the date, right, was $2, right? So the market value of this is going to be $2. So 32 million is going to be the value of the investment there. Okay. Then we have the cash consideration, the cash payment that needs to be done in 3 years. So the deferred payment is going to be there. The deferred cash payment. And the terms of the payment is that we need to pay $1 per share, right, that is acquired by on Becky, right? So we are acquiring 24 million shares. So we need to pay $1 per share. So we have to pay altogether 24 million shares, right? Okay. So you need to do is you need to discount these cash flows, right? So you have your 24 million. 24 million. Now here we need to use the discount factor, right? They are given us the discount factor which is 0.75 at the cost of capital of 10%. In 3 years it's going to be 0.75. So 24 million into 0.75, 24 into 0.75 is going to be 18 million. So 32 plus 18 million, the total investment that we have done in Becky is going to be 50 million. So your double entries to record the investment, write your journal entries. The journal entries. Investment in Becky is going to be 50 million. Then you have the deferred liability. So your deferred liability will get credited by 18 million. Investment is an asset, so you will have to debit it. Now here you have a share exchange. So when you have a share exchange, the shares will be valued at the share capital and the share premium. So the market value of a share was $2 while the nominal value was $1. So the share capital will be always using the nominal value to value our share capital. So the parent has issued 16 million shares. So 16 million shares valued at $1 each. The share capital will get credited by 16 million. And the premium per share again for 16 million shares. The market value was $2. The nominal value was $1. So the premium per share is going to be $1. So 16 into $1, your share premium will also get credited by 16 million, right? So those are the journal entries to record the investment in Beckett. Later on, you have the unwinding of the discount. Here, of course, you only need to do it for 1 year, but to help you all understand, right, I will be doing it for all 3 years. So year 1, year 2, year 3. So the interest is going to be charged on the balance of the liability. The interest will be charged at 10%. So the initial recognition or the initial valuation of this deferred liability was 18 million. So in thousands, this is 18,000. So 18,000 into 10%, 1,800 or 1.8 million would be the interest. This figure is also in thousands. Then your double entries to record this would be your deferred liability would get credited by 1,800, and your finance cost in the statement of profit or loss would get debited by 1,800, which is 1.8 million by profit. Then this basically increases your liability. So when it comes to the second year, the balance of your liability would be 19.8 million, which is 18 million plus 1,800. So on this 19.8 million, we'll be charging 10% interest, which is 1,980, right? So then 19.8 million plus 1,980, 21,780 would be the balance of your liability. So 21,780 into 10%, 2,178 would be the interest. Now when you look at the closing balance, the final balance, right? So year 3, the closing balance, 21,178 plus 2,178, sorry, 21,780 plus 2,178, that is going to be 23,958. Now this is because of the rounding of errors, you'll be seeing a difference of 2,000, right? Basically, once you keep charging the interest, this amount will equal to the total amount that needed to be paid, right? We had to pay 24 million, right? So we are almost at that same value, right? So if because of rounding off only, there is a 2,000 difference, right? So normally you should get the same value, right? Total. So this is how you would be unwinding the discount and accounting for a deferred consideration, right? The initial measurement as well as the subsequent accounting adjustments. Okay, So we need to calculate the cost of the investment by the parent. So first we have the cash consideration, the cash investment. The cash investment was $5,000, right? And then they also issued two $1 shares for every 5 shares held in S and agreed to pay further 2,000 in 3 years' time. So we have a share issue. So the total amount of shares in S is 5,000. So we have only acquired 60% of this. So 5,000 into 60%, the number of shares that we have acquired would be 3,000, right? So $3,000 shares that we have acquired. For every 5 shares that we acquired in S, so 3,000 divided by 5, we are given 2 shares of the parent, which is D, right? So the number of the shares that was issued, 3,000 divided by 5, into 2, that's going to be 1,200 shares. The market value of a share at the date of acquisition was 1.8. So 1,200 into 1.8, 2,160 is going to be the amount raised from the share issue. Now this investment has to be debited, right? So this will be taken as a share issue by the parent because the parent has issued shares, right? So the share capital will increase. Now the parent had issued 1,200 shares. The share capital will increase by the nominal value, so 1,200 into $1. So the share capital will increase by 1,200. And the share premium, $1,200. The market value of a share was 1.8. The nominal value was $1. So we are looking at a share premium of $0.8. Okay, so 1,200 into 0.8. The share premium is going to be 960. Then finally you have the deferred consideration. So the deferred consideration was a cash payment of 2,000 in 3 years' time. So it's going to be a cash payment of 2,000 In 3 years time, we are not being given the discount factor, we will have to use the discounting fraction. So 2000 into 1 over 1 plus r. So the rate here is going to be 6%. So 0.6, and the number of years, the rate, we have to do this payment in 3 years time. So n is going to be 3. So if you do the calculation, 2000 into 1 over 1 plus r to the power of 3, 1.06 to the power of 3. So you'll be getting 1679. So you'll be recognizing a new liability, which is your deferred liability. Your deferred liability is going to be 1679. Okay. So if you look at the investments, your investment is going to increase by 2160, which is coming from the share issue, 1200 plus 960. Then you have the deferred consideration of 1679. The total investment by the parent is going to be 5000 plus 2160 plus 1679. That's going to be 8839. And then you have the finance cost that is coming from unwinding the discount. So we'll have an additional note, unwinding the discount. So the loan liability that is 1679, that into the interest of 6%. So 1679 into 6% interest. So that is going to be 100.74. So we'll round it off to 101. So the finance cost that is coming from the unwinding is 101. And this finance cost of 101 needs to be added to your deferred liability. So your deferred liability will increase by 101.